And gentlemen, good morning and welcome to the Q3 FY23 earnings conference call of Apcotex Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Sonpal from Valorum Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you, Michelle. Good morning, everybody, and a very warm welcome to you all. My name is Anuj Sonpal from Valorum Advisors. We represent the investor relations of Apcotex Industries Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the third quarter and 9 months ended of financial year 2023. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Let me now introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Abhiraj Choksey, Managing Director, and Mr. Sachin Karwa, Chief Financial Officer. Without much delay, I request Mr. Sachin Karwa to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj. Good morning and welcome everybody to today's earnings conference call for the third quarter and 9 months ended of financial year 2023. I hope you had an opportunity to review the financial statements and earnings presentations which have been circulated and uploaded on the website and the stock exchanges. To brief you on the financial performance for the third quarter of financial year 2023, the revenue from operations were reported at rupees 234 crore, which declined by about 7% on year-on-year basis. The operating EBITDA stood at rupees 30.6 crore, with EBITDA margins reported at 13.07%. The net profit stood at rupees 20.4 crore and PAT margin stood at 8.71%. For 9 months of FY23, the revenue from operations stood at around rupees 824 crore, which grew by roughly 21% year-on-year basis. Operating EBITDA stood at rupees 124 crore, a growth of around 32% on year-on-year, with EBITDA margin standing at 15.1%. The net profit was around rupees 85 crore, a growth of approximately 25% on year-on-year basis. PAT margin stood at 10.28%. During the quarter, volume was flat with 1% growth on year-on-year basis as we were running at full capacity utilization. EBITDA margins were lower due to inventory losses in Q3 with respect to raw material and finished goods, which was impacted primarily by supply chain constraints and price decrease in raw material. Lower margins were also seen in some product categories, partly due to fall in ocean freight benefiting imported competition and fall in exemplary margins due to market conditions. On the CapEx front, both the projects in Taloja and Valia are expected to be completed in Q4 of the financial year. The delay in project is due to supply of key equipment. Additionally, I am pleased to announce that we have declared an interim dividend of rupees 2 per equity share, and 7 February 2023 has been fixed as a record date by the board. With this, I would like to open the call for question and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all the participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the first question from the line of Dhiral from Phillip Capital. Please go ahead. Mr. Dhiral, I have unmuted your line. Kindly proceed with your question. Mr. Dhiral? As the current participant is not answering, we move on to the next participant. The question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Yeah. Thank you for taking my question. So my first question is related to the, I think, slide number 6 on your presentation, where you mentioned that EBITDA decline has been primarily due to raw material and finished goods inventory losses. So just wanted to have more color on this in terms of, say, six months down the line or 1 year, slightly longer term. How do you look at these raw material prices moving forward, and how will that impact our performance, and how we are geared up for that?
Right. Good morning, Ankit. So, as in most of the quarterly concalls, I've been saying that our nature of our business is that there are times when we benefit from prices going up, and frankly, the last 4 or 5 quarters, previous 4 or 5 quarters, that has been the case. We definitely have benefited. Now, things have turned since petrochemical prices started sort of falling steeply, and that has obviously impacted our margins, partly impacted our margins. That's not the only reason, but that's one of the main reasons why that has impacted our margins for this quarter, and likely to continue into Q4, mainly because, we are dependent on a lot of imported raw materials, and given the uncertainties in supply chain over the last 2 years, and I think to some extent the uncertainties continue in China and in Europe, we had increased our inventory days, and we continue to do so. So while we benefited when things were, rising, obviously this was expected, but we have no choice. It's part of sort of this business, and in the long term, to answer your question, it's hard to say, but obviously we feel the prices have now almost bottomed out. So things should start rising from, maybe the next quarter or end of this quarter onwards as well.
Thank you. That really helped. And my second point was related to, again, the same slide where you mentioned about fall in ocean freight cost benefiting imported competition. In our last call, you mentioned that we get the benefit in terms of exports in Middle East and Southeast Asia, where freight cost is not a very large percentage of total cost of the product. So how do we see that as a percentage of our total exports or total sales? So assuming that the price of or the ocean freight remaining at this stage for some time, how are we positioned?
Yeah, so obviously, I think it's a 2-part question. So for imports, because for about 40-45% of our products, we are the only manufacturer in India. So for the Indian domestic market, obviously our only competition is imports. Now, what happened over the last 2 years, I would say pre-September, October, is that ocean freights have been obviously very high, as we all know, and that has benefited us for the Indian market. And that, of course, that one-time benefit that we had for a few quarters is now almost, we are back to pre-pandemic kind of ocean freight levels in most cases. So that one-time benefit is sort of gone now. And as far as exports is concerned, of course, those, because most of our exports are in countries close by, it was never a big impact. Obviously, those rates have also come down substantially, and that's benefiting us, of course, for exports.
Okay. And my last question would be in relation to...
Sorry to interrupt, sir. I would
kindly
request you to...
Fine, let him finish with his last question. So
Okay, sir. No problem. Proceed, please.
Sure. Thank you. Thank you so much for allowing me. My last question is related. In the last call, we mentioned about excess capacity being there throughout the world in terms of the glove manufacturing. Any update on that? Do we see any changes, or it remains to be like that?
Yeah, it's quite, the downturn of the glove industry still continues. It started sometime last year in 22, and that continues, and that's been one of the reasons of our lower margins also. While it's a small percentage of our total sales, XNB latex for gloves, around maybe less than 10% so far, we enjoyed extremely high margins in 2021 and early parts of 22. And obviously those have kept coming down, and they are really, compared to the pre-pandemic average, much, much lower. That is expected to continue for the next couple of quarters, 1 or 2 quarters at least. From all industry reports, we've been in touch with customers, and they feel that once the old inventory is used up, that will certainly help. Some of the excess capacity that's been recently created, those companies are obviously not doing well with high investment, so maybe there will be some consolidation. So we think it will be the second half of this calendar year when things should change.
Thank you so much. I'll come back in the queue for my other question. Thank you so much, and all the best.
Thank you.
Thank you. We have the next question from the line of Aditya Khetan from Smith's Institutional. Please go ahead.
Sir, thank you for the opportunity. Sir, my first question is on the nitrile latex side. Sir, onto the channel inventory, now what we are witnessing, so that is at the minimum level into nitrile latex. So how you see the demand right now? And we know that the nitrile latex prices also, so they are at the lowest levels.
Yeah.
So what should be the trigger for prices and demand going ahead?
Yeah, look, for us, we are currently selling only 10% of our sales is nitrile latex, or less than 10% also. Obviously, we are coming up with a 50,000 ton plant for nitrile latex in Valia, which is still a small percentage of the global market. So selling 50,000 tons is not so much of a challenge. The issue will be, of course, given that the current, there's not much pull from the market, it's a lot of relationship building and pushing that we're doing. So it may take a little longer to get to full capacity for 50,000 tons, maybe a year or so. We were earlier expecting 6 months, but now we think it may be a year or so. And as far as margins are concerned, look, that's anybody's guess, but we think, as I said, I mentioned to the previous caller, that we think in 6 months the market should turn, but it's certainly going through its deepest downturn, the glove market, and therefore the raw materials that are being supplied to the glove market, going through the deepest downturn that it ever has. So, but in the long term, we are quite bullish that, with the growth in healthcare requirements across the globe, we believe it's a high growth market for nitrile latex, as well as a shift from natural latex gloves to nitrile latex gloves. And we are well positioned in terms of geography, raw material pricing, everything, and new plant at a reasonable capex compared to most of our competitors. So all those things, in the long run, we are quite bullish. Of course, we are entering the market at a time when there is a downturn. So that's the reality.
Okay, sir, you said to take the market to a U-turn, it will take 6 months. So from May or June, we can expect pickup in demand.
Well, yeah, that's from all industry, discussions we have had, they've been saying second half of the year, yes.
Okay. Sir, my second question, sir, onto the benefit of the realizations which we have got in the last 3 quarters. So wherein we had made around 45 crore of EBITDA. Now we are down to around 30 crore of EBITDA in this quarter. So how you see these things to improve or maintain at these levels, at least for the next 2 quarters?
Yeah, I mean, look, this quarter, again, the same challenges will remain. Q4, I'm talking about Q4. And then as the new capacities kick in, we expect EBITDA to improve if there is no other major, issue or change, because raw material prices will also bottom out, I think, in this quarter. So at least this quarter, we don't expect a major improvement, but hopefully from Q1 of the next financial year, there should be some improvements, yeah.
Okay. So just one last question, sir. You have mentioned YOY volume growth of 1%. So similar on quarter-on-quarter basis, how much was the decline in volume?
There was no decline.
Okay, so 17% decline in revenue, that was primarily led by realization.
That's right.
Okay. Thank you, sir.
Yeah, that's a good point. So I'll just clarify, because I'm sure we've been running at full capacity and we continue to run at full capacity in Q3. We focused on total volume, holding market share, and yes, to some extent the margins have come down in some of our product categories, but we've had to deal with that.
Sir, just one last question from my side, sir. One more question, sir. Are we witnessing any increase in imports, since you have also mentioned that the freight rates have gone down? So imports might have increased. So competitive intensity will have also increased. Is this also one of the reasons? So which is leading to decline in realization?
Yes, absolutely. That's one of the reasons. And so but as I said, we will hold on to our volumes and market share, and we have had to correct our prices in some of the products where we face intense import competition. I think one of the other reasons has also been, overall slowdown in China over the last few months, and a lot of imports have been directed towards India because we are one of the few, India is one of the few shining spots in the world today where demand overall has not been affected. So if you see our India demand, the demand has not been affected. It's a question of raw material pricing, little bit higher intensity in competitions in some product categories. That is what has caused sort of this reduction in EBITDA quarter on quarter.
Okay. And sir, this expansion which we were planning,
Sir,
this
I'm
was
sorry
supposed
to
to start in
interrupt,
Q3 only. Sir, any reason why this has been shifted to Q4?
Okay, I'll take that question and we'll move on to the next caller if you don't mind, Aditya.
Yes, sir.
Okay. Yeah, I mean, look, the main reason has been that, a lot of delay in semiconductor, wherever we were using semiconductor equipment where we were buying that used semiconductors were, incredible delays, and that's been, I guess, the main reason. But now everything is in place. We have got everything. We are in the mechanical completion stage. In fact, the plant is ready, and both plants are ready. And we are already doing water trials, and we will be we expect by the end of next month, so about in a month from today, to start the product trials as well.
Thank you. We have the next question from the line of Aditya from Securities Investment Management Company. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So I just wanted to get a better understanding of a synthetic latex business, excluding the nitrile latex or glass. So what are the market dynamics over there? So do we face competition mainly from domestic players, or are there imports as well? And I believe since we are a market leaders in most of these products, so are we facing margin pressure over here, or are we able to pass on the price decrease over here?
So here I would say we have mostly domestic competition. There is some import competition, but the margins have been fairly good, I would say, for synthetic latex outside of nitrile latex. And we mainly have domestic competition, one major domestic competitor for this. And they've been by and large okay, but obviously these higher cost raw materials that we have had to import, I'm sure they have as well. But the market, corrected quickly in terms of finished goods pricing. So to some extent there has been some reduction, but not major reduction in margins in those products.
Right. So just to follow up, so what is the pricing policy for the company for the synthetic latex business? So what is the frequency of the price pools that we have with the customers, and do we book raw materials on a back-to-back basis to protect us from inventory losses?
Yeah, so there are a couple of pricing models we have. One is we have formula pricing for some large customers who are willing to commit volumes, and the rest of them are on spot basis. So I would say wherever we were on formula basis, we obviously lose out when we were buying. Formula is based on some published raw material rates, and our actual rates of buying are obviously different. And when prices are going up, we benefit. When prices are coming down, it's a disadvantage to us. With spot, of course, we are quicker at sort of passing along the price increases or decreases. But sometimes when you're stuck with a lot of high cost inventory, maybe there is some pressure in the short term to reduce prices when prices are coming down. Because they do get prices of what the imported prices are, so even though imports may only be 15-20% of the total market, it still impacts the entire market in terms of pricing.
Right. And what will be the proportion of the formula-based pricing and the spot pricing?
Totally as a company, I think it's about, can I come back to you on that? But obviously, it's still a smaller percentage. I think maybe about 25% or so would be formula pricing, and the rest would be spot. As a company on the whole, I'm saying.
Okay. And if I look at the margin profile of the company, pre 2016-17 we used to make around 8 to 10%, but now we are guiding for around 13 to 16%. So just wanted to know what has changed for the company in these years, which has led to the increase in margins? Is it just, a scale, or are there any other factors which has helped us achieve such margins? Because when I look at the product profile of the company, we have added nitrile latex, but it is currently constituting in single-digit revenue, and we have added NBR, which also makes company level margins only. So margin accretion wouldn't have come from change in product mix. So what has led to the increase in our base level and profitability?
I mean, couple of reasons. One is, of course, as you said, economies of scale kick in, as we kept growing. The second is our customer profile, our product profile. We have moved into some specialty grades also, which are much higher margin, obviously lower volume. So all, combination of reasons have helped overall margin. And of course, as you grow, the ability to buy at a lower rate, better procurement buying. So all, multiple reasons. I would say 4 or 5 different reasons.
Okay, but sir, would the change in product mix would have led to increase in margins because the products have remained more or less the same, right?
No, but within the product, as I said, there's customer mix as well. So earlier, for example, we had, if I were to give a specific example, in the paper industry, there was a large focus on, or large percentage of our sales were 2 or 3 large customers. Now, as we have grown and as the industry has grown, now there are a bunch of middle and smaller level customers where margins are better. So we have not grown because our volume has been capped. We have purposely sort of focused on customers which are higher margins. Similarly on exports as well. Initially, while we were getting in the approval phase, we had to give pricing at a much lower level to break in. And now that we have broken in and proven to be a consistent and good quality supplier to some of our export customers, we've been able to increase margins over time. So these are just a couple of examples I'm giving you.
Okay. And what is the capex guidance for next year, and what kind of maintenance capex is required in our business?
So as of now, after this capex is done, which is around 200 crores this year, we have not taken a call on further major capex, and we expect a maintenance capex of about somewhere between 15 to 18 crores per year.
Okay.
And that also includes improvement. Some of those projects are not necessarily maintenance, some may be debottlenecking, some may be cost reduction. So some of them will benefit, and some are pure maintenance, which is just replacement of material. So we have some small projects which also help in overall margin improvement, either because of revenue increase or cost decrease.
Right.
I'm talking about in general that we see over the last 3 years, 3-4 years. Okay. And we expect that to continue in the next year.
And what percentage of our power requirements are met through captive sources, since power cost is a big cost for us?
Yeah. So in our Valia plant, I think entire power comes from captive power plant. We have a cogen power plant which manufactures steam as well as power for us. And in Taloja, we are dependent on MSCB. We do have some small percentage of wind and solar power, but it's a very small percentage of our Taloja requirement. So right. Can we give an opportunity to the next caller, some other callers as well?
Thank you.
Thank you.
We have the next question from the line of Nagesh Jain from NB Investments. Please go ahead.
Hello.
Yeah, go ahead. We can hear you. Good morning.
Good morning. Very good morning. First of all, regarding the inventory loss that you have mentioned, is it possible to quantify how much was it in the last quarter?
Yeah, it's possible, but we are not revealing those kinds of numbers. But I would say at least, it would have made an impact of, at least a couple, 1 or 2 EBITDA, 1 or 2% in EBITDA.
Acha. So was it there in Q2 as well?
Sorry?
Was it there in Q2 of this current year?
Q2 was a benefit, right? As I mentioned to the previous callers, that the previous 3-4 quarters we had a benefit of inventory gains rather than inventory losses.
Okay. And you are saying that this loss may be there even in the current quarter, Q4.
Yes.
Okay. My second question is regarding the NBR project. I know to the previous caller you said that there is no significant capex for the next year. So does it indirectly mention that you have still not taken any decision on expanding the capacity of NBR latex?
Yes, that's correct. We've not taken any decision. We are completing our, we're in the middle of completing our sort of detailed engineering for that project. But the final call will take, because we want to ensure that our balance sheet numbers are also healthy and we are not taking too much of a risk on that. So we've not taken a call on that yet. Yes.
Okay. So this latest gloves part, you said that it will take more than 6 months to ramp up to the full capacity. But at the same time, the margin expectation also will be low from that product?
Yes, exactly. Exactly. And it will take longer than 6 months. We think maybe up to a year now it would take to ramp up to full capacity.
Thank you. We have the next question from the line of Farooq Pandoli from Avista Fund Management LLP. Please go ahead.
Yeah, hi Abhiraj. Just wanted to check. Hello?
Yeah, go ahead. Hi Farooq. I can hear you.
Just wanted to check, have we started manufacturing from Valia? And if so, what is our utilization at this stage? And is any of this capacity, given the issues that you've highlighted, is any of it sort of swing wherein you can maybe divert some of it to other segments?
Yeah. So, no, we have not started manufacturing. As we mentioned in the opening remarks as well as to previous callers, there's been a further delay. I know earlier we were supposed to be September, October and December, but because of some delays in semiconductors, a lot of our automation equipment was delayed by a huge it was ordered in a month's time. So now everything has come. Of course, we've received everything and we have installed everything. We're in the middle of final testing and final approval. The CTO, as they call it, consent to operate for both our plants in Taloja and Valia. To answer you, so both will start up by the end of February, early March, with trial runs, and then of course ramp up over the next 6 months to 1 year. Earlier, the plan was to make nitrile latex in both plants. 50,000 tons we had in Valia and 10,000 tons in Taloja. Last time I mentioned that the Taloja plant was a swing plant, and so we have made some additional investments to make it a swing plant, because we believe that in our current set of products in SB latex there has been a lot of pull and demand, and therefore what we have done is converted that plant to be able to manufacture any product. So that's a full swing plant and ready to go from next month. The good thing though is that we have now, while we have 50,000 tons of nitrile latex, we can make up to 35,000 tons of SB latex in Taloja. So totally, in terms of revenue, it would amount to about, current price is about 600 to 700 crores. And so earlier I had mentioned 450 to 500 crores, I believe was the thing. So with the current 200 crore investment, we should get about 600 to 700 crores. So this is how we are looking at the next couple of years, that we would have nitrile latex coming from Valia and other latexes from Taloja, where obviously the margin profiles in the current context are better, and tomorrow, a year later, if the margins in nitrile become better, we can always switch. So that's the kind of provision we have left for Taloja. In Valia, we are unfortunately unable to do that, and so it will be a nitrile latex plant only for now. In the long run, if we want to make some additional investments and we have some options, but we have to have additional investments made to do that. We still believe in the nitrile latex will be a good market in the long run. Obviously, in the current context, last 6 months and the coming 6 months, the margin profile is quite poor. Glove industry is not doing so well. But in the long run, I think it should. We strongly believe that things will turn, especially since it's a 10 to 15% growth market. So I think that will turn. So overall, the way we are looking at our projects is that this investment of about 200 crores will give us a revenue of about 600 to 700 crores, in addition to the 1,000 odd crores that we already have. Plus, we have left, provision for additional investments at a very low cost. So I want to say maybe around additional 30-35 crores will give us another revenue, additional revenue of 300 crores. So we have built the company or built these projects to ensure that we can get to 2,000 crores without any significant investment. So I know it was a long answer, but I hope it answers all your questions.
Yes, it does. Also, can we get some idea of, the level of profitability in nitrile latex today versus maybe 6 or 12 months ago? As in, what has been the dilution in profit because of inventory issues and the other things that you mentioned?
Latex is not because of inventory issues. That's been mainly because of overall, market being sort of very weak. The inventory of gloves. Yes, you're right. Because of high inventory of gloves. So, I mean, margins are pretty much crashed from, they were. Let me put it this way: if there were 100 pre-COVID or pre-pandemic, they went to almost 300. And now they're down to less than 50. So it's half of what they were pre-pandemic, less than half of what they were pre-pandemic.
Thank you. We have the next question from the line of Dhiral from Phillip Capital. Please go ahead.
Yeah, good morning, sir. Thanks for the opportunity. Sir, I missed that part. As you said that from the incremental capex of 200 crore, now you are looking at a revenue of 600 to 700 crore. So just wanted to recheck. So what kind of change in the product mix we are looking at? Sorry, I missed that part, sir.
No. What I mentioned is that as far as the Taloja plant is concerned, we will be focusing on our existing latex products, styrene butadiene latex, styrene acrylic latex, VP latex, and so on, from that swing capacity. And because the cycle times for those products are lower than nitrile latex, we are able to make about 35,000 tons against 10,000 tons. And in Valia, it will be 50,000 tons of nitrile latex, so totally 85,000 tons of latex, which amounts to about 600 to 700 crores at current prices.
Okay, got your point, sir. And sir, what kind of utilization we expect from the nitrile latex in FY24, as you are expecting some change in the situation from the H2 FY24?
Yeah, look, it will be obviously in the first few months it will be very low and then ramp up slowly. We hope that by the end of the year we will be at in the last couple of months of the year of the financial year we would be at full capacity. And for the year, we may be less than 30, 40, maybe 40%, because obviously the first few months will be at very low capacity utilization, because we will still be going through the reapproval stage, because it's a new plant, so customers require us to send some small amounts of material and then ramp up slowly. So maybe 40% for the year.
And so lastly, because of the fall in the realization and the margin, at what utilization will break even?
You mean break even? See, operating costs, I mean, what do you mean by break even? Overall, there's hardly any increase in fixed costs. So we would be breaking even at a very low at a very low capacity utilization.
Okay, got your point, sir. Thank you.
Brownfield project, so the additional cost is mainly just additional manpower needed to run the plant.
Sure, sir. Thank you so much.
We have the next question from the line of Romil Jain from Electrum PMS. Please go ahead.
Hello, sir. Thanks for the opportunity. Sir, I just want to understand the Taloja plant that you mentioned, the ongoing capex, which will, I think, start next month. So 35,000 additional manufactured. But apart from that, also we can manufacture other products which can give similar revenue. Just clarification on that front.
I did not understand the question.
No, so I think, as you mentioned, 35,000 tons of additional nitrile latex can be manufactured at Taloja.
SB latex at Taloja. Styrene butadiene latex, styrene acrylic, other products.
Okay, other products. But we can also manufacture the nitrile latex there, is what the new capex is.
We could also do that, yes.
Okay. And still make similar revenue.
No, the revenue would earlier the plan was to make only nitrile latex, because the margins were very strong. So the revenue was lower. So as I said earlier, the plan was totally 50 and 10,000 tons. So totally 60,000 tons, 50,000 in Valia and 10,000 tons in Taloja for XNB latex, with a revenue of about 450 to 500 crores. Now,
Okay.
that has changed because we are able to make much more other kinds of latex through the same plant. So now the revised revenue that we will generate from these plants will be 600 to 700 crores, with an option of with sort of marginal investments to get another 300 crores from there.
Okay. Got it. And just second question is, the current margins that we have, that we have reported, I think on the EBITDA side, about 13 odd %. So this is with the pressure on the nitrile latex part of it, which is less than 10% revenue. So I'm assuming that the other part of the business, right, that is broadly still stable and still sustainable in terms of margins.
Yes, we have, as I said, broadly yes, but in the short term, because of some high cost raw materials, we've had an issue. And also in some pockets, some product categories where we get a lot of import competition, for example, some of our synthetic rubbers, we have seen margins also drop due to market conditions. But we believe those are sort of temporary phenomena and part of the business cycle. It happens for a couple of quarters and goes back up. So, but by and large, yes, the other part of the business is okay.
Okay, so that means, as you mentioned, that maybe the next 6 months to 9 months, I think as things stabilize on the nitrile latex front also and utilization increases, these margins may be broadly quarter margins and there may be a swing towards better margins, is what I'm trying to understand.
We hope so, yes, we think so. Look, overall, there are 2-3 things that we are quite bullish on. One is that, look, the company is now well positioned with very minimal investments to get to 2,000 crores over the next maybe 4 to 5 years. So there's no additional major investments required. Number 2, our return on capital, even at these margins, return on capital, return on net worth is quite healthy. And number 3, yes, we feel that we are a quite well diversified company. So, and we've created one of the things that COVID has taught us is to be more flexible, and now our plants are much more flexible. So in case there is a downturn in one industry, we can always make it up with products. So to some extent, we are able to do that. Not 100%, as I mentioned to the previous caller, for a new nitrile latex plant. As of today, the 50,000 tons is only built for nitrile latex, and the whole plant is built for nitrile latex.
Okay, got it, sir. Thanks a lot, sir. I'll come back in the queue.
Sure.
Thank you. We have the next question from the line of Nikhil from Simple. Please go ahead.
Yeah, hi. Good morning. Can you hear me?
Yes, can. Good morning.
Yeah. Just 3 questions. One is, sir, you mentioned in 40-45% of our business, which is where the dynamics are driven by imports. Even after the price drop, would you say our volume share in the industry are sustained? So we are maintaining our market share even though imports have increased. Would that be a right assumption?
Absolutely, 100% right assumption. That, as I mentioned again earlier, that we are running at 100% capacity utilization, and even we continue to do so this quarter as well in Q3. Prices fell overall, and we have to correct our prices, but we held on to the volumes and the market share.
Okay. Now, second on the glove latex, I understand, and so 2 questions. One is, in the previous calls you had mentioned that even though the industry dynamics have gone bad, we would still be able to maintain a ROC on the capex at 20% plus. The conditions which you mentioned that pre-COVID, if we were at 100, today we are at 50. Yeah. Would you say if this sustains for some time that 18-20% ROC is still sustainable for our new capex, or would it be dilutive to some extent?
So I think of course, when I was talking about 20-25% ROC, we were looking at the next 5 years, and obviously the expectation was that margins would improve, that they would not remain at these levels, and they would at least improve to pre-pandemic levels. But as I said, so if even at pre-pandemic levels, ROC would be even better. But even if you have to sustain 1 year of low margins, for example, and then margins improve after a time, after 1 year, we would still. That's what I meant, that over a 5-year period, we're still quite confident that at least a 20-25% ROC on this new project would also be possible.
Okay. And just last question on the glove latex. We understand that there is a lot of capacity which came from the glove manufacturers. But how is the capacity addition which has happened at the latex side? So has the latex side capacity addition been in line with the glove manufacturer capacity addition, or is?
No, I don't think it has been as much as, because the glove capacity is easy to add quickly. As far as latex for gloves is concerned, the current players are the ones that have increased capacity. So some capacities were already in the works, and like ours, for example, we had already started investing, and some were announced. So I believe the ones that were announced and no money was put in have all been put on hold. So our view is that the latex capacity is not obviously gone up as much as the overall glove capacity in both China and Southeast Asia. And it's more the glove capacity that is an issue, and the glove manufacturing that happened over the last couple of years, which caused a lot of excess inventory. So once those things correct, I think over time, in a market which is growing at 10 to 12% minimum, if not 15, things should correct itself in a couple of years.
Okay, and just one last question, if you permit. If you look at most of the suppliers in this industry, the latex manufacturers are backward integrated with a petrochemical channel or petrochemical backward integration or based out of Malaysia. While we have to import a lot of RM or we don't have such a strong backward integration advantage. So if we have to understand our advantage in market share gains, is it more on incremental market share gains, or is it more on we are replacing someone else with our new capacities in the glove latex side? So how are we gaining market share there, and what is the advantage we enjoy?
Please understand that it's not necessarily true that they're all backward integrated. There are a couple of competitors that are not completely backward integrated, and even a few of them that are, they have many other products. So the two main raw materials for this latex is butadiene and acrylonitrile. Now butadiene, we have sources that are very close to our plant, and that is true of some of our competitors as well. In fact, some competitors in Korea are importing butadiene we are not importing, we are hardly importing any butadiene. So that is an advantage to us. And acrylonitrile, I don't think anybody is backward integrated. They're all buying from the market. Yes, in some cases, acrylonitrile is available in the same country. So to that extent, freight, raw material price volatility, all that is avoided. But we believe that we are not at a major disadvantage because large quantities of acrylonitrile are also imported into India at pretty competitive prices. And we are able to get those. So we feel in terms of raw material pricing, we're not in any way at a disadvantage to any of our competitors.
Okay, fine. I'll come back in the queue. I have a few questions.
Thank you. We have the next question from the line of Saurabh Shroff from QRC Investment. Please go ahead.
Yes, hi, good morning, and thanks for the opportunity. Abhiraj, just first question on the balance sheet. So as of September, we were at about 145 odd crores of debt. Should this peak out at about 200 crores by the end of March once the plant gets commissioned?
Yes, Sachin, can you answer that question? Are you there?
Yes. Yes, it will be.
So, yeah, and from what I understand currently, because prices are coming down, even working capital requirements have come down. So to some extent, that's helped us. And I think when you're counting debt, I think you're looking at overall long-term debt as well as working capital, right?
Yes, correct.
Yeah. So that should
that is actually going to be
I don't think it will even get to 200 crores, Sachin. What do you think? Maybe 160, 170? Because a large chunk was already done, right?
Yes. So right now, I think you have almost the volumes utilized, and so yeah, we should be in that range.
Yeah, okay. Around 180, 200 crores.
And this should include the additional working capital debt also that you will need once the plant.
Yeah, I think so.
Yeah. Okay, got it. And Abhiraj, I think you had mentioned, maybe it was a few quarters ago, is there any sort of work by any of these majors that acrylonitrile could start becoming available locally? I'm guessing it's a couple of years away, but is that...
There has been some talk, but I don't think there's anything that's hit the ground as far as I know.
Okay, so no progress has been made on that front.
As far as I know, in the last 3-4 months, I don't think there has, yeah.
Fine, okay. And finally, on the last question, the new capex at sort of Valia or Taloja, the new plants, are they any more or less sort of labor intensive, i.e. more automated, and hence the confidence that with a very little fixed cost base you are sort of going to break even? Is that the understanding?
Exactly. It's literally, I mean, I was personally surprised with the level of automation that we have been able to pull through. And so, just to give you an example, in our Taloja plant, 35,000 tons, which will give us at least 250 crores of revenue, 250 crores. We need an additional maybe 6-8 people per shift. Just that's it. So it's highly automated. Everything is run from automated DCS systems, and of course, some amount you do require physical manpower for packing and such, but a lot of it is automated, much more than our current plant. Yes.
Thank you. We have the next question from the line of Vishwa Shah from Samohara Investments. Please go ahead.
Oh yeah. Hi. Good morning, sir.
Yeah. Good morning, Vishwa.
Sir, I just wanted to get an understanding on the raw material pricing that you said affected us because the petrochemicals prices have gone down. So what I wanted to understand is, because we've stocked up on inventory during lockdown at a very high price, is why we are being affected by the steep crash in the raw material right now. That's question one. And secondly, I wanted to know about what happened with the anti-dumping duty case that we had filed with CSTAT. So yeah, just to throw light on both of them.
Yeah. So the first one, yes. Repeating what I mentioned before. Yes. Over the last 2 years, we have continuously had to have higher amounts of raw material inventory just because of the uncertainty around imports. And I also want to mention even domestic raw material inventory. We also increased some of our inventory days because some of our domestic suppliers were also dependent on imported raw materials. So we wanted to ensure that. We didn't want to have this false sense of comfort that because we are buying from a domestic source, everything will be okay. So as a result of which, overall inventory days have gone up, and we continue to maintain those. Maybe in the next 3 months we may reevaluate, 3 to 6 months, but as of now we continue to maintain those. So while we had that benefit, while prices were going up for 3 or 4 quarters, 4 or 5 quarters, I would say, obviously from this Q3 onwards, that has reversed. So that has been part of the reason why our margins have been lower. Not the full reason, but part of the reason. And your second question on anti-dumping duty, absolutely, we've appealed for anti-dumping. We've got some favorable sort of judgments in our favor as well, but nothing has come out of it as of yet. I think it's still in the courts. Basically, the appeals and all are going on. So we're, it's going on the side, but it's something that doesn't affect our day-to-day business right now.
Okay, thank you so much. And sir, just last question. The borrowings that have increased from March 22 to up till now, that was mainly for the two capex that we've incurred in the 2 plants, right?
That's the only reason. Yes, absolutely.
Okay, and so in the last call you had mentioned that it is 50-50, like 50% internal accrual and 50% debt. So that is the case, or is there something?
Approximately, yeah, you're right.
Okay. Yeah.
I mean, maybe 55%. I'll have to work out the exact numbers finally, but maybe, Sachin, what do you think? 55-60% debt or 50?
Yeah, 60% approximately would be term loan and balance will be internal accrual.
Okay, got it. Thank you.
Thank you so much, and all the best for the further quarters.
Thank you. We have the next question from the line of Amar Maurya from Alphatech Advisors. Please go ahead.
Am I audible? Hello?
Yes, sir.
Yeah. Good morning, Abhiraj. Thanks a lot for the opportunity. So, wanted to understand, as you indicated that this quarter EBITDA per kg or realization were down because of the inventory loss. So, is it like, let's say, by 2 quarters we will come to our historical average EBITDA kind of level, and will this and what was the freight cost, what was the higher freight cost which were penciling into the realization, if you can indicate that?
Difficult to exactly say how much freight cost. Look, I look at it from a long-term point of view. Today we are about 1,100 crore company this year with an average EBITDA of about 15%, I think.
Correct.
We feel fairly confident that in the long term, to maintain these kinds of EBITDA levels and maybe even improve them as economies of scale kick in, as XNB margins return to normal pre-pandemic levels, etc. So the way we are looking at it is that the capex that we have made today will take us from 1,000 to 2,000 crores with some additional marginal capex over the next 3 years. Okay. And we want to maintain those EBITDA margins, Now, there could be some quarters where EBITDA margins are a little lower, like this quarter we've had. Maybe even it may go down further in some quarters. I have no idea. Maybe there'll be 11% one day. I'm not sure. But we have also, maybe we'll do 17, 18% in some quarters, So that's the nature of this business, that we have to live with these fluctuating EBITDA margins due to the raw material volatility and sometimes market dynamics in some of our product categories. The good thing is we've created a well-diversified business. We're not only focused on one or two industries, so if those industries go down, suddenly our margins will go to 5%. Those kinds of things which used to happen in the earlier days, I don't think will happen going forward, and I think economies of scale will help as well.
Correct.
So that's the way we're looking at the business, but quarter on quarter, very difficult to predict.
Yeah, got that. And secondly, the capitalization will happen in Q4, right? For both the asset, the 200 crore capex?
Yeah, that's right.
And for 200 crore capex, you indicated we took some 50% debt, correct?
Yes, approximately, I think 60% debt. Yeah, but totally, 200 crore capex was for these two projects, plus we had other maintenance and other projects going on. So for the year, maybe 200 I would want to say for the year, but for FY23 as well as part of FY22, totally to 220-230 crores was our total capex, and about 125 will come through long-term debt.
Okay, perfect. Thanks a lot, sir.
Thank you. We have the next question from the line of Rohit Balakrishnan from iThought PMS. Please go ahead.
Yeah, hello.
Yeah, go ahead, Rohit. Good morning.
Good morning, sir. Thank you. A lot of the questions were answered already, and thank you for giving very detailed answers. So just a couple of questions. So one was, you talked about being very diversified in terms of your industry mix. So can you broadly give the share of your top 5 industries in terms of your revenue mix? I couldn't find it you've mentioned the industry, but if you could just give a broad sense, and if you could also give what it was, let's say 5 years back to now.
Sure.
Very broad numbers, right? Yeah, don't need exact numbers.
So that's a good point. So I'll mention about 7 years ago, before we made the acquisition of Omnova Solutions India. Before that, I would say maybe 30 to 40% of our sale was to the footwear industry, 25 to 30% was to paper, and the rest, 10-15% to paper, tire, 10-15% to construction, and so on. In the current context, and I'm talking about FY23, I would say about 15 to 20% would be paper and paperboard. Construction would be another close to 15%. Carpet would be 10%. Carpet textiles put together would be 10-12%. Tires would be another 10%. And nitrile latex is another less than 10%, 7-8%. And the rest is all rubber products, which include footwear, automotive, hoses, rice roll, all different kinds of applications, from agriculture to auto to all different kinds of industrial hoses. So many different applications. So the final industry consumers are very, very varied now, and no one industry has more than 20%. And once glove market also starts kicking in, obviously glove will become a larger chunk, maybe 20% of our overall sales, but the others will grow as well.
Right. Very helpful, sir. And this, in terms of, you mentioned the next, this capex would help you to reach to about 2,000 crore with some more smaller investments. So, this is over the next 4-5 years or earlier than that. How do you see that?
Yeah, our endeavor is next 4 years. That would be 3 to 4 years that we should be able to get to 2,000 crores with this capex. And of course, any additional capex project that we may take, for example, as I've been telling, additional NBR capacity is something that's in the works that we are looking at, plus some new projects, potential, inorganic growth opportunities as well. So that's all addition to this. I'm just talking about the investments already made.
Right. And the peak debt you're saying is about 200 crores, right? 170 crores, right? Including term working capital, everything.
Depends on the working capital requirement and when prices go up, because we find that when suddenly prices shoot up, obviously a working capital requirement goes up, and when they come down, it comes down again. But yeah, I mean, I don't think it will cross 200 crores, maybe 180 crores or so.
Right. And last question, sir. I mean, you talked about this diversification of product and industry. So just from a slightly different question, but in the same light, is that so typically when the prices fluctuate, let's say if they go down versus, you also mentioned in the earlier call that, like, for example, import prices now become competitive. So how frequently do your customers switch from, let's say, you versus somebody else, and how fungible is that? If you can just give some example. I'm sorry if you've already answered in some of your previous phone calls, but
it's actually, it's not, as long as we're by and large price competitive, customers do not switch. So obviously, for example, market falls by 20% and we don't decrease the price at all, customers would be unhappy and then start looking for alternate options. So generally they have two options. But given that one of the things Apcotex has done over the last 10 years is become a strategic source of supply for most of our customers in most of our industries. We have major tire cord manufacturers, all the major paper and paper board manufacturers, all the major construction chemical companies. I don't think any of them have had even 1 month where they've not bought anything from us. So as long as we're price competitive, and we assure them that we would be, we have a high amount of stickiness with our customers.
Thank you. We have the next question from the line of Karan Bhatelia from Asian Market Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. Am I audible?
Yes.
Sir, on the exports, what was the contribution and the growth we've seen?
For which period? But I have those numbers somewhere. So overall, we've been at about 20% of our total sale is exports. And in terms of growth, I have numbers for the YTD first 9 months. We've seen about a 11% growth in exports this year compared to last year.
Right, I think that was helpful. And sir, you mentioned that nothing probably could change materially in terms of realizations and in terms of margin for the fourth quarter. So will we running at peak in volumes for the fourth quarter as well?
Yes, that we continue to do so. Yeah, we're running at full capacity even now.
And the capex outflow for FY23 could be?
Around 200 crores.
Okay, thank you. That's it from my side.
Thank you.
Thank you. We have the next question from the line of Anubhav Dahun from NC Research. Please go ahead.
Thanks a lot for the opportunity. So most of my questions have been answered. Just one on the peak revenue guidance. Now, given that the market conditions have changed, and now that both the plants will essentially be targeting different set of products. So would it be possible for you to give a breakup between two plants in terms of investment and expected revenue? I mean, basically a breakup of 200 CR investment and 600 to 700 CR expected peak revenue.
Yeah, so out of the total capex of about 200 crores, I would say 70% is in Valia and 30% is in Taloja. Between 70 and 75% in Valia and 30% in Taloja. And in terms of revenue, maybe that will be a higher percentage for Taloja, so maybe 40% Taloja and 60% Valia. 35, 40% and 60%. Yeah.
Okay.
Going forward, yeah. From the new plants.
So, okay. So the change in strategy, I mean, I understand that the plant was already supposed to be swing one. But the change in strategy is decided by both the regions, right? The changing dynamics for the latex gloves as well as the strengthening and demand for the other latex products, right?
Yes, that's correct.
Okay. And sir, in that context, could you also talk a little bit about the demand outlook for the non-auto end markets like construction paper and carpet?
Fantastic. Overall, I think overall demand in India has been fantastic for these products. There is all our customers in India as well as abroad, both. I would say abroad meaning Middle East, Southeast Asia, wherever we're doing exports. The demand has been phenomenal. In fact, we have not been able to cater to the demand because of our limited capacity. And our team is quite confident that in the next 2 to 3 years, we will be able to utilize even the Taloja plant 35,000 tons extra that we have now invested in. Yeah.
Okay, that's great. Thanks a lot for this. Yeah.
Thank you.
Thank you. We have the next question from the line of Sandeep from Anand Rathi. Please go ahead. Mr. Sandeep, I have unmuted. Mr. Nikhil, Mr. Nikhil, I have unmuted your line. Kindly proceed.
Hello.
Yeah, please proceed.
Yeah, can you hear me?
Yes, yeah, good
yeah,
morning.
Thanks for the repeat. Just one question on the glove latex industry. Now, as we mentioned that the capacities have not come up to the extent the way glove manufacturing capacities have come up. But what we understand in that gloves, there are a lot of, it's a very fragmented industry where there are many glove manufacturers. But on the latex side, how is the industry structure? Is it pretty consolidated? And where I'm coming from is that if the industry is consolidated and there are multiple glove manufacturers which are finding pressure on inventory and on demand, so is the pricing also being impacted on the latex side, or is it more of the utilizations have dropped significantly, which is a cause of concern for the industry?
Yeah, I think, so to answer your question first, obviously the latex industry is much more consolidated than the glove industry. In the glove industry, guys from small to $3 million revenue to, billions of dollars of revenue as well, large manufacturers in Malaysia, Thailand, China, and so on. So it's fairly consolidated. Obviously, as the demand has gone down, utilization has come down because also all these current latex manufacturers also added capacity over the last couple of years. And therefore, when utilization is down, there is automatically demand on or pressure on margins, and that's what's happened on both the gloves and the latex.
Okay. So in a way, if we look at the price fall, if we be more commensurate with the RM fall, but not a steep fall other than what the RM fall has happened. So it's not like some people are trying to get to market share at whatever price and the industry dynamic, impacting the industry dynamics.
No, that has also changed, right? Because even though there are no new players, the existing players plus us, like we are a relatively new player, we have come into the market. That way there are one or two others also that are coming into the market, or I don't think they've come in yet, but will come in this year. So as a result of which the current nitrile latex manufacturers, they are trying to hold on to market share, and it has become much more competitive. It's not just raw material.
Okay. And just one last question. If you have any idea of what would be the utilization at which the industry would be working, the latex industry would be working currently versus what it was pre-COVID? Any rough estimate just to get a sense?
I don't have that with me ready right now.
Fine, sure. Thanks a lot.
I'm not sure, but because it's changing every month on month, things are improving now slowly, but difficult to give an exact number.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
I'd like to thank all of you for joining this Q3 Concall. Just to summarize that, while we are in a challenging phase and given the overall current macroeconomic environment, plus some specific local industries issues like the glove industry, etc., we are quite bullish and confident of where the company is positioned currently. We're quite comfortable at much lower capex than most people could do in the world. We've been able to generate this additional, or we will be able to generate a revenue of 600 to 700 crores, which can go up to 1,000 crores with a further minimal investment, which we will come back to you, of course, in a year or two as and when we are ready to do that. And while margins quarter on quarter can vary in this kind of business, we are hopeful that we'll stay in the mid-teens and continue to grow the business in a healthy manner, keeping in mind diverse product range, diverse customer range, diverse geographical reach, and of course a healthy balance sheet. So look forward to seeing you all in the next quarter. Thank you very much.
Thank you. On behalf of Apcotex Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.